Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, September 5th, 2016. Happy Labor Day to all you in the States, and for those of you outside the United States, hope you had a good weekend, and hope your work week is off to a good start so far. In this video, we'll take a look at gold, silver, and the gold mining stocks. We'll start out here with GLD. Take a look at a few different views from the daily time frame, touch on the 60-minute charts. We'll then take a look at silver via the SLV ETF, and finally we'll take a look at GDX and try to get a feel on where the miners are headed this week and maybe beyond. All right, this is one view. I have several different. There's just a lot on the chart of GLD. Don't pay too much attention to anything to the left of the chart. Let's just look at what's happened most recently here. One view, and on this chart I've shared in recent weeks. These were my pullback targets. This was an old target from that previous divergent high back there. That target that was hit back in earlier in this year, back in May. What I'm looking at now, we had this most recent divergent high, and this was the first target area. So as you can see, gold, did a pretty good job. We shot a little bit below there on Thursday and Wednesday of last week. Friday with the disappointing, we had a miss on the employment numbers, which instantly reduced the odds for a rate hike, and which sent gold higher and the miners as well. Now, there was also some technical developments in place. I had mentioned in the trading room earlier in the week, I think on Wednesday, on silver, I had mentioned it in particular. SIL, I should say, the silver miners ETF. We had potential bullish divergence on the 60-minute charts. We had the same bullish divergence on GDX, and that played out and was confirmed on Friday on that big move up. So in one day, it was both confirmed on the big move up on GDX, as well as meaning a bullish crossover of the MACD, as well as it may have played out for a good part, if not all of the move that really was foreshadowed by that 60-minute divergence. And again, I'll wrap that up at the end with the GDX chart. So here's gold. And more importantly, from looking at this chart, we've essentially hit the first target. These targets, especially when there's sharp moves in an asset or a very volatile sector, in this case commodities such as gold, and even more so in the miners as far as volatility, that's close enough there. I didn't have gold as official trade idea, so these aren't exactly hard targets. And you can see came, within basis points. I don't even think it was a full, less than 1/4% or so, about 1/4% below that level. So that's the reaction. For those of you who have often talked on this, it's explained in detail in the frequently asked questions section on the site under the trade ideas or trading FAQs. The reason I have different targets, or I'll highlight a support level, I only do so if I think the odds for a reaction are elevated at that point in time. And a reaction I define as one of two things: either a consolidation, sideways trading action, which we did, we consolidated for a few days, and or a bounce. And so far that's a bounce. So we've had a reaction off that level. Now, I'll just state it up front. I don't think the correction in gold is over. I don't think that was it. Reason being is really my read on the charts based on the scope of the pattern, these divergences, which I'll get to here in another view on GLD in just a minute. But it looks to me, resistance, if we really zoom in here, put a horizontal line, I can see these candles here. You can see the candlestick bodies, these two candles, as well as some of these back here. That would be our first resistance area, and it's just overhead. I mean, we could pop there in the morning. We could even pop there in the overnight session. And but that's around, call it 127. Let's just put that marker up there for you guys to see. So that would be the first horizontal resistance level. Then we had this uptrend line before, which gold gapped down below. You can see how well that was defined by numerous candlesticks over the last month or so. And if we happen to take out the 127 level, that would be my maximum upside target. But it just appears to me, let's flip over to another board here. There's a couple things to look at. All right, this is the same daily chart, so we're looking at a span of 2 years. Unless I zoom in, there's 2 years. We zoom in a little bit to just take a look at what's happened. This is what I'm referring to when I say the scope of the pattern. What's happened to gold? Very similar to the stock market, actually. So far this year, we've had a series of 3 consecutive divergent highs. You'll notice a lot of lines drawn here. and they're identified here. We had I zoomed in so it moved the annotations. Let me move that over. Okay, right here was our second consecutive divergent high. I didn't have it listed. This right here, this high back on around the end of April, early May, I guess you could say May 2nd, there was our first divergent high, and that formed this bearish rising wedge pattern defined by this uptrend line, and there was your divergent high. We traded that correction. Again, it was shown on this other page. The target was hit. So I'm flipping boards. I have a lot of different lines. I don't want to make it too confusing by putting everything on one chart. So that played out as divergences usually do, especially that one took the form of a bearish rising wedge pattern, played out for a nice correction in gold, biggest correction of the year at that point. Then, similar to the broad markets, we put in this second consecutive divergent high. By consecutive, it's just you can extend that previous divergence, and it makes a larger or a second consecutive divergent high, and that also resulted in a decent correction, not as much as the first one. And what happened is gold snapped right back up and put in now a third, more recently I should say, a third consecutive divergent high on July 6th. So really, this is what I'm looking at. From this point back here where the divergence started, February 11th, up until that most recent third divergent high on July 6th, this tells me that gold, this pullback so far, which has been relatively muted in my opinion, especially based on the scope of those divergences, that's a drop of not even 5% in gold. I think there's more to come based on this, based on sentiment, how crazy bullish sentiment has gotten in gold, and some other factors there. So that really speaks to the fact that I think this is just a reaction off the first support level. It was expected to have a reaction around this level. We've had that reaction. There could certainly be more. We can draw a downtrend line. We could actually draw a few. So again, I can see a little bit more upside, but it's not worth, in my opinion. I've left the GDX short trade on. I'm still personally short Nugget and at least a couple other individual miners, and I'll touch on those if I have time. But so that's about a 1%, maybe a little bit more than a 1% upside to that downtrend line, and that's around 127.90. It would come in tomorrow when trading starts if it were to get there. And then I would expect a continued move down. One other thing to look at on gold is there is this uptrend line. We have 1, 2, 3 reactions there, a fourth reaction there, and now we've had a fifth reaction. So this is a key. This is now what I would refer to as our primary uptrend line. We have this uptrend off the December lows in gold when gold bottomed, and so far a reaction there. And if that breaks, if my scenario plays out that there's more downside to come, we're going to break that primary uptrend line, and that could take us quite a bit lower. We're also looking at, if you look down here at the MACD, I often mention how the MACD, it's such a simple and effective trend indicator. MACD can be used for many things. We can interpret or at least analyze the MACD and try to identify divergences such as the negative divergence that we had here. That helps to anticipate or identify potential trend reversals, which so far we've had. And also when the MACD, I like to use a signal line. I talk about that often, the 9 EMA. When it is below, as it crossed below back here, we were in a downtrend, kind of tested that zero line, the dotted line, went above it for a little bit. But for the most part, when it's below, as it was from here to here, the trend is bearish. And when it's above, it crossed above. Remember, the bear market in gold, or the previous bear market, ended back in December, right there. That point, that was around December 17th. And just a couple weeks later, that MACD trend indicator crossed into bullish territory and has remained bullish briefly on that one of those corrections, that the deeper of the two that I mentioned, briefly came below the zero line, went right back above, and has traded above since. So now, as you can see, the posture of that MACD signal line, the 9 EMA, it's crossed below by just a hair, but it's pointed lower. So this could indicate if we get below, we may have a new, what I would say, intermediate term downtrend. I'm not at this point thinking that the bull market in gold is over. I'm open to all possibilities, but I'm just looking for a little bit deeper correction at this time. But it would really help greatly strengthen that case to see this uptrend line go. One more thing to cover. would be the Fibonacci retracements. Oop, I flipped these upside down, so let's just take a look. You know, most corrections, and I'll get to this in a second, I'll look at it in silver. I don't know if I did it on gold. Most of corrections in a primary trend, you'll see at least a retracement down to the 38.2% Fibonacci level, Fibonacci retracement level. Corrections can range anywhere from 30 to 32. I mean, they can go anywhere, but if they go much beyond the 61.8, in other words, if you correct 100%, you've wiped out the trend. But this is the common range. There's other Fibonacci numbers, but I like to keep the 38.2, 50, and 61.8. And that is usually the minimum criteria to satisfy a correction, and we haven't even come close to that yet on this pullback. Let's see, you can take a look at the previous top right here. Again, this is from the move from the lows to that previous reaction high, and look at this, is almost a nearly perfect tag of that 38.2 Fibonacci level. Trader stepped in, and gold continued higher. So at this point, like I said, we're far from, if you look at the total move off the bottom, far from that. Even if we want to look at the move up from this level here, we did satisfy a 38% retracement just off that previous run. So that, you know, to give you the glass half full scenario, you know, I'm giving you my take that I think there's more downside, but looking at it from this point of view, maybe at least in the near term, we go a little higher because we did hit that 38.2 fib, and some traders will watch that level. So there's gold. Now let's jump over to silver. And again, I said we'll use the SLV. Please ignore everything over here to the left of the chart. That's all stuff that showed the divergent low, you know, built the longer term bullish case. But right now we're just looking in the very near term to the intermediate term. So I'm looking over the next week or two what may happen with gold and silver. These were some target levels that I had here in silver, that 1790 area. There's really a support zone. We overshot it just a bit, consolidated around there, and popped up. And we're right at, just closed a hair above this resistance level. See this big gap back here? This was a very significant technical level. That gap was back, it tested from above successfully, tested from above. You can see that last candlestick close right here, and then boom, we gapped down into the gap, fell below it, came back up. So that whole area, we closed a little bit above it on Friday. So let's see what happens this week. And as far as, let's see if I can put a downtrend line here on SLV to watch. Yeah, we sure can. And there we closed just a hair above it. Not enough to really clearly say we've taken that out. So again, let's see how we follow through. As far as trend indicators go, you can see that the 9 EMA is below. We are poised to make a bullish crossover, but we haven't made one. And sometimes we'll come up, the MACD line, the blue line here, will kiss it and then roll back over. So, you know, hard to take too much, but I can tell you from a trend indicator point of view, you can see how well, you know, once we traded above, silver bottomed back here with that divergent low. The signal line, the 9 EMA, crossed above and has been bullish the entire time throughout this entire rally, with a very brief whipsaw right here. And then got back above there. So now we're clearly below. In fact, we're, you know, at this point, that signal line is by far, you know, I can try to tell you the level. It doesn't matter. You can see it visually. I'd have to get the crosshairs right on there and look at the level. But we're well below the zero line, and that's indicating there might be more downside to come in silver. Let's see if I have any other boards, any other interesting things. Okay, here's some things to look at. Very busy. It looks like a Christmas tree. Let me zoom in. All right. Each of these lines, the purple, or I think you call that magenta, this yellow line, the blue line, they're all off the lows in silver when silver bottomed back in December. And I'm just measuring to the left on the screen. You can see the Fibonacci levels. We had this first, the purple line. You can see that retracement came and took us back to the, right here from that high, 50% retracement. If I move it over here to this first reaction high, we came back just below the 50% level. And what I'm getting at here is showing you how in the vast majority of corrective phases, even in an ongoing bull or bear market, in this case, you know, the current trend is bullish, the longer term trend, you know, you usually get these pullbacks to at least that 32.8. So in this case, these first two reaction highs both resulted in pullbacks to about the 50% fib area. So let me get that one off. Then, again, we're going from the bottom right here, the lows back in December. You can see at this key reaction high right here, we had the first, not the first, these were the first two corrections in silver, but this was the biggest one up to that point in time. And look how perfectly it kissed that 50% Fibonacci level. Again, just follow that dotted line to the left, and you see the 50% Fibonacci retracement level, and boom, off to the races. Okay, so there's another case where the correction wasn't satisfied until we hit a key fib level. Now here we are on silver. I'll just leave this one fib up, and as you can see, here's the 38.2 fib, which is usually the minimum I like to look for on a pullback, and I haven't seen that so far. In fact, for those of you, Elliott waivers, or even if you're, I'm not much of an Elliottician. I do think there's some value to be seen, but the thing with Elliott wave is it's often too many after the fact revisions. But one of the more simple things is during a primary trend, corrective phases usually go in ABC pullbacks. Not always, but so far this looks like an A move down, a B move up. We have some resistance a little bit overhead, maybe we're up to about that 1870 level. We could stop here. There's resistance here certainly, but this looks like a B up with a C wave down to come. And that's silver. I think I covered everything on silver. Yep. All right, let's move on to GDX. Okay, nope, GDX. Here we go. I have a few different boards. The most notable developments on this daily time frame is this very pronounced divergent high. We had a divergent high back here. See the bearish rising wedge pattern, and that led to a correction once that trend line was broken. Actually broke, back tested a little, and then rolled over. And now we have another bearish rising wedge, not as steep as the first one, but the divergence is actually a little more steep here. You can see on the MACD and the RSI down below, and I'm referring to the point right here. From this high, prices made a higher high with the MACD making lower high, a lower high, as well as the RSI, and boom, a very powerful correction so far. And right now we had a little consolidation there. That was that bearish pennant on the 60-minute I pointed out, and we broke down, continued with impulsive selling, and this looks like the first counter trend wave. So this again may be a B up, which could have a little more upside. Hard to say. Could have run its course as of Friday. We hit that resistance level where I expected GDX to stop, and I'm still looking for a move down. I don't have targets on this board. Let me see if I have any here. The GDX trade is based off the 4-hour chart, so I'll get to that. Well, let's just go ahead and jump over there and look at that. Here's a 4-hour chart. We fell. I was a little aggressive with my target because I put the target at 24.85, which, as most of you know, I typically set my price targets on a short trade just above support. And in this case, I thought the move would be very impulsive, and might maybe even overshoot that. So I actually set the target T1 at 24.85 right at the actual resistance level. You can see when I hover, the little, well, actually you can't. There's a pop-up box, but it gets cut off to the right of the screen. But that line is at 24.85 here. I can show it this way. Edit, show value, and there it is. So far, as I said, we reversed just shy, within basis points of the price target. But I don't think it's over. You can see on the 4-hour, the MACD is deeply in bearish territory, and I still favor possibly a little more upside, maybe not, but ultimately I'm talking the reversal should come sometime this week, if I'm correct, by the end of the week, early next week latest, and then a move back down to the second target at 22.28, and that one is set well above the actual support level that I have. Let me add that, is at 22.06. You can see it there, and you can see, so I set the final target on GDX comfortably above that level. And what I like about this 4-hour chart too, and it would work well the same on the daily or 60-minute, the Fibonacci's, these were horizontal support levels where I placed those lines, and they line up perfectly with that 38 and 50% Fibonacci level. So I still have a very high degree of confidence that these price targets will be hit. It's just how much are we going to bounce before then? When are we going to reverse? And I think, again, I'm looking at probably anywhere from the bounce is over to maybe a little bit more upside this week. And let's drill down to the 60-minute charts and take a look at that. Try to gauge how much more upside we might get. All right, here's the 60-minute chart. These are the divergences I first pointed out on SIL, the silver ETF, in the trading room earlier in the week, and then I think it was Thursday pointed out the potential divergences. And with that big move up on Friday, that confirmed the divergence, meaning we had the bullish crossover in the MACD, and the divergence has been confirmed. So there it is, 60-minute divergences on just about all the indicators and oscillators. And the bear flag fell a little shy of the measured move. If you look at the flagpole leading down there, this is where it would have projected to. So we reversed a little shy, and again, that had a lot to do. It had everything to do with the employment data on Friday. So a news-driven event, but the technicals were there to confirm this bounce. And as you can see, here are my target levels. This is where I expect things to stop, the bounce in GDS, this R1 zone, which runs from about 2750 up to 2780. Then I have R2, resistance level 2, it's about 2846. Then this R3 zone, this would be my final stopping point for GDX should things carry a little higher, and my scenario play out for more downside. So that's 2905, call it the 29 to 2937 level or area. So resistance zone 1, resistance level 2, resistance zone 3. I give it a zone if there's gaps or two support or resistance levels in close proximity. That's where I give it refer to it as a zone. Trend indicator, as you can see on the 60-minute chart, at least on the MACD, that the 9 EMA, the signal line, is still below 0. We had a slight cross up on this 1333 histogram. Although I will say on GDX it's a little more whippy than it tends to be in the broad market because of the volatile nature of GDX. There might be a better moving average pair to use. I use this trend indicator primarily on the broad markets, but I can show it here as well. All right, and finally let's take a look at silver, or the silver mining stocks. Okay, I stated, in a couple weeks ago when I started put out the first video, warning of a very likely correction in the metals, and put out a lot of trade ideas. I mentioned that I thought the silver mining stocks had the most meat on their bone, more than the gold mining stocks, and so far that's been the case. They've had a very sharp correction, off the highs. You had this very well-defined and very steep uptrend line. Double divergent high. You had a divergent high here with a minor correction, and it went on to form a second divergent high. And so far, the silver mining ETF has dropped over 22% in very short order, as you can see. And you can also see as we zoom in, other than this consolidation, I had this first target level. This was not an official trade idea. I threw out a lot of trade ideas, and I gave you these targets. And 4602 was the first target, and that line was actually at 4556 as I highlight it, and it gives a pop-up. Oh yeah, you can catch that in the pop-up box there. I think that makes it into the screen. So that line's at 4556, and you can see how well technical analysis works on the metals and miners. Here, these previous reaction lows to find that level, we came down, hit it. We had the reaction. I talk about this is exactly what I refer to as a consolidation, a bounce and or consolidation. We consolidated for about 4 or 5 days, moved a little bit below it, looked like we were heading lower, and we snapped back above it. So we're still consolidating, if you will, around that area. And again, from the look of this, look at the MACD pointing lower. We did reach almost oversold levels very close to the 30 reading. But I think there's more downside to come, although there may be a little more bounce in the short term here. This is a 60-minute chart of silver I just flipped over to. There's the divergences. So you can see, just as with GDX, and of course there's a lot of overlap. There are quite a few silver stocks in GDX because a lot of those companies pull out both gold and silver out of the ground. So there's a chart. Looks like we took out that trend line. There's the divergence that I mentioned in the trading room, and it has started to play out. It broke out, but what I could also see is this wedge still playing out, but doing something along these lines. Let's say we hit, there's some resistance coming in right about where we stopped the other day. resistance runs all the way up here, but a very possible scenario, in fact the most likely, is maybe come back in and back test this thing at lower levels next week, and that might bring us down on GDX. It should certainly bring us to at least the first target on GDX if we hit that, and then a possible bounce from there with these divergences then going on to play out. And if you look at the MACD, we might put in, I have to draw it here, maybe another higher high, a second divergent low if we come to back test this wedge below last week's lows. I can see the possibility for a second divergent low, and that would leave for a more lasting move. For those of you, I know there's some of you in the trading room, and maybe you don't care to short the metals and miners, but you want to know when to get back in. I don't feel comfortable at this point. This correction may be over. That's quite possible, but I can state outright that I don't feel comfortable going long. In fact, I'm still short and still looking for more downside. But if we have this second divergent low, this type of scenario, and the charts align with gold and silver as well, and look like they've likely bottomed, then that might be our opportunity to position long on some of these individual miners or the ETFs like GDX, SIL, Dust, Nugget, whatever you prefer. All right, and finally I'll wrap it up with HL. We had a couple individual official trades. SBGL was one of those. We already hit that final target and covered that one. And this is HL. I've left this one on as an active trade. I still own this one personally. Still think there's more downside. I mean, this is just to me a beautiful chart. That's why it made it on as an official trade. Although there were a lot of beautiful charts in the video I did a couple weeks ago, a week or two ago on the metals and miners. But this one, you can see the breakdown of this very well-defined uptrend line, divergent high, impulsive selling, and so far we've consolidated. And these are why we have these targets. We hit that first target almost perfectly, if you can see that candlestick there. So we hit T1 quickly, came down and hit T2. And remember, the miners are very volatile, so these day-to-day, intraday swings are big, but this is perfect consolidation here. You can see right around that T2 level. Oops, wrong drawing tool. Let me try another one here. I think this will do it. So there it is. So this is when I refer to an expected reaction at each target level. Well, we had a reaction there. We closed on it that day. Then we gapped down below. Quick impulsive move. Once support was broken, once that T1 level gave way, we went right down to T2. And for over a week, we've consolidated around that level. Just a little bit above, a little bit below. And from the look of this chart, I don't believe that correction is sufficient to satisfy such a large steep rising wedge with confirmed with divergences at the top to see a correction like that and then to continue on higher. I think this is a consolidation period, the first wave down, and at least like I said, maybe an ABC wave correction, A down, B up, and maybe we bounce back up. That certainly that first target level, I had 632 as T1, but the actual resistance level now, the former support now resistance, is at 630. And so maybe a little more upside, maybe not. I don't know, and that's why I didn't take that one off yet. And finally a move down to the T3 level there at 487 is the final target on that one, at which point it's possible it could go lower. We'll have to take it as it comes. If my analysis proves correct, assuming this bounce in the miners is not over, which I don't believe it is, meaning that we go lower, we may continue lower. I'll more than likely cover my position here unless I state it ahead of time on the site. That will remain the final target. But if things develop in the charts that convince me that there's a strong likelihood we're going to go down beyond the targets that I'm looking at now on silver and gold, and I may extend the target on HL. I might even add a few other trades on, but I'm just as likely within the next week or two to start adding some longs if I see the evidence in the charts to tell me to do so. All right, we'll leave it there, and as always, if you have any questions, want an update on a trade or any of the other numerous, unofficial trade ideas that I posted on the site or in the trading room recently or in that last video, by all means, shoot me, post a message, ideally in the trading room so others can see and maybe benefit from the chart or the analysis that I give. All right, this has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.